Some impetus is expected to come from fixed capital formation in the outer period of the forecast. At a sectoral level, the agricultural sector is expected to return to positive growth following good rains in a number of regions and improved maize crop estimates. A modest recovery in the manufacturing sector is expected following 2 consecutive months of the ABSA PMI being above the neutral 50-point level, whilst the mining sector is forecast to respond more favorably to favorable commodity prices. Low growth in gross fixed capital formation remains a downside risk to growth in the short term. In 2016, gross fixed capital formation contracted for the first time since 2010, with the ratio of fixed capital formation to GDP declining from 20.4% in 2015 to 19.6% in 2016. Private sector investment remains particularly weak, having contracted for 5 successive quarters. This is reflected in the RMB BER Business Confidence Index, which increased marginally in the first quarter of 2017, but at 40 index points remains well below the neutral level of 50. The BER Manufacturing Survey shows a sharp decline in expected capital investment over the next 12 months, with the political climate cited as the main reason. The constrained growth outlook does not bode well for the employment creation in the economy. According to the quarterly labor force survey in the fourth quarter of 2016, compared to the fourth quarter of 2017, employment increased by 0.3%, whilst the number of unemployed grew by 11.3%. This resulted in an increase in the unemployment rate by 2 percentage points to 26.5%. Consumption expenditure by households, which grew by 0.8% in 2016, remains subdued amid low consumer confidence. While growth of 2.2% was recorded in both of the final 2 quarters of 2016, negative retail and wholesale trade sales growth in December and January underscore the likely persistence of this weakness. New vehicle sales continued to decline in February, although exports increased significantly. These trends are expected to persist as the impact of a higher tax burden, low employment growth, and weak wealth effects take their toll on consumption expenditure. In addition, credit extension by banks to the private sector continues to grow at low rates, particularly to the households amid a further decline in the household debt to disposable income ratio. Expenditure will be supported to some extent by positive but moderate real income growth. Fiscal policy, as outlined in the recent budget, remains committed to a steady pace of deficit reduction over the next 3 years. Lower tax revenues relative to budget, partly as a consequence of slower economic growth, have resulted in a shortfall to be filled by a combination of lower expenditure growth, increased fuel levies, and other excise duties, and a number of tax changes. These include limited compensation for fiscal drag and a higher marginal tax bracket for high-income earners. The tax increases are expected to act as a drag on household consumption expenditure, particularly for middle and upper-income earners. International oil prices have declined following increased oil inventories and weak compliance with the OPEC brokered deal to restrict output and an increase in shale gas production in the US. Although Brent crude oil prices increased by about 10% in the wake of this agreement, these gains have been largely reversed, with oil prices back in the region of $50 per barrel for the past 3 weeks. The impact on the domestic petrol price will be evident in April, when a reduction is expected. Despite the 39 cents increase in the road accident fund and fuel levies provided for in the February budget. Since the previous MPC meeting, the inflation outlook has improved. However, the risk to the inflation forecast has been affected by the reaction of the exchange rate to the current elevated levels of political uncertainty. At current levels of around 13 rands against the US dollar, the exchange rate is still moderately stronger than the level implied in the exchange rate assumption in the forecast. However, the rand is likely to react further to unfolding developments until a greater degree of certainty and confidence is restored. The possibility of significant overshooting of the exchange rate in the short run also cannot be ruled out. As always, the MPC will attempt to look through short-term fluctuations and focus on long-term trends in its policy settings. The MPC remains concerned about the elevated level of inflation expectations. While the near-term reversal was not unexpected, given the deterioration of the short-term inflation outlook in January, the longer-term expectations remain anchored uncomfortably at the upper end of the target range. Not all the inflation risk factors are on the upside. The deterioration in the forecast at the previous meeting was due in part to a higher international oil price assumption. This assumption has not been adjusted to reflect the recent market developments. There is a downside risk to this assumption, given the possibility of these more moderate trends persisting. A further downside risk comes from electricity price increases, which could turn out to be lower than the 8% currently in the forecast from mid-2017. The final price determination by the energy regulator is yet to be announced. Overall, the MPC assesses the risk to the inflation outlook to be moderately on the upside, mainly due to the high degree of exchange rate uncertainty. The MPC sees no evidence of significant demand pressures impacting on inflation. The growth outlook remains disappointing, and the MPC is concerned that increased political uncertainty could impact negatively on private sector investment and household consumption expenditure, and further undermine employment growth. The risks to the growth outlook are therefore assessed to be on the downside. In light of these developments, the MPC has decided to keep the repurchase rate unchanged at 7% per annum. 5 members preferred an unchanged stance and 1 member preferred a 25 basis point reduction. The MPC is of the view that we may have reached the end of the tightening cycle. However, the committee would like to see a more sustained improvement in the inflation outlook before reducing rates. This assessment may, however, change if the inflation outlook and the risks to the outlook deteriorate.